Thanks, Johan. Hi, everyone. So pleasure to be joined by this great set of panelists and participants alike. So we are almost at the verge of Christmas, and therefore probably everybody is wrapping up their 2023 and looking into 2024. Those of us who are present at this panel probably will all share their experiences from different angles. So my particular angle would be around the business part of launching the neobanks or financial solutions or digital wallets, whatever you want to call them. Different people call it different things. But I'll try to address the topic of partnerships and finding the right partners, and basically how to think about the licensing part, the banking part, the all those things that might be a little bit frightening or intimidating to the people just starting their journey in building digital finance solution. So the topic of my talk would be how to find the right partners, or who needs banks anyway. So it's a bit tongue-in-cheek, but the reason I'm pretty confident about talking this topic with a little bit of humor is I've been in traditional finance and software development for more than 10 years. I used to be a management consultant with Bain Company, a vice president at Mastercard, one of the most traditional, at the same time, one of the largest FinTech companies in the world. I used to be a COO at one of the neobanks in Europe, and I'm currently a member of the board at one of the Ukrainian banks. So heavily leaning into the traditional finance and the larger banks and the traditional infrastructure, I still feel there is a way to bridge between the startups and traditional finance. And the key goal of my talk would be around trying to give some snippets on how to actually build that bridge. So, as some of the people might think, the large startups that exist in this world, and the ones we actually are knowledgeable about and probably are using on a daily basis, the likes of Stripe, Coinbase, Square, or Robinhood, all of those fintech startups share one common feature. They actually have nothing to do with banking. So they are primarily tech companies, and the way they build themselves, they actually use what is often called an invisible bank to power themselves, to basically build their tech on top of what the traditional banks have to offer. And we'll talk a little bit about what exactly a bank can bring to fintech and what exactly a fintech could bring to a bank. So the names on the left-hand side of the slide, like Cross River Bank or Celtic Bank or Sutton Bank, probably doesn't ring any bell to people who are not deeply in the fintech space. But actually, these invisible banks are the ones powering the fintechs and helping them build the regulatory bridge into the finance world by being, the licensing elements to their technology, and being often the balance sheets, and helping those fintechs thrive and grow. So those three banks, which probably none of the participants, or very few of the participants, would have heard about, are actually behind the success of the likes of Stripe. So Stripe is a financial technology company, with tech being more important than financial here. And the banks like Cross River, Celtic, or Sutton, many other banks, in fact, they power those fintechs. They help them with their license, with the balance sheets. So in fact, we shouldn't be too afraid about banks. We shouldn't be intimidated by the fact that they're large and financially stable and huge and well established. They actually are as eager to partner and work with fintechs as are fintechs to work with banks. Another fun fact, even some of the largest digital banks in the world are often not banks. So one of the largest neobanks in the world, called Chime, primarily focused on the US market, having 15 million customers, are actually explicitly not marketing themselves as a bank and do not possess a financial license. They're just using their technology to help customers manage their money, manage their accounts, and live a generally healthier financial life. Same goes with Revolut. So few people know, but actually out of the 20 million customers that Revolut has, only probably half of them are working through Revolut's license, which has been granted in Lithuania. And the number one market for Revolut being the UK, they're actually not a regulated company, not a regulated bank there. So they're just, again, they're using their technology to making the life of ordinary customers, ordinary people easier, and don't necessarily strive for a banking license or a banking charter. Definitely not in the US, where it's extremely complicated. Another example could be a company called Wise, formerly known as TransferWise, which enables financial cross-border transactions between people and businesses alike. And having 16 million customers, they're actually not a bank. So they're present in probably 80, 90 countries, and only in few of those geographies do they possess any type of license. And in none of those geographies, they actually have a banking license. So as Bill Clinton once said in his presidential campaign, some of the people who are older in this call might remember that. It's the economy stupid. Actually, it's not the economy, it's the technology. So often the technology is what is important in those digital FinTech solutions, not the actual license. License is just a key that helps you unlock the door, but what you're going to do with all those customers and your product offering is entirely up to the founders of those FinTech companies. So I think whenever anyone thinks about what is the path forward in terms of licensing, what is the path forward in terms of building the product, one should probably ask themselves, the founders should ask themselves, which of the two are they in FinTech? Are they the fin part or are they the tech part? So despite the slightly intimidating financial element in FinTech, the actual products that we enjoy on the daily basis are just the tip of the iceberg, which is built on top of the many things which are provided by partners, often licensed partners, which have been in the market for tens of years, even hundreds of years. And the actual product that we see is the technology, the user experience, the features, the business features that we built with our product, and not the more or less commoditized offering among many elements in financial technology, like accounts or cards, for some of the blockchain or crypto banks, on-off ramps, acquiring for everyone, KYC and AML, cloud solutions, and much, much more. So, probably no one, whenever starts to think about the products, would think about building the cloud themselves in the beginning, right? So everybody would just tend to use either an Amazon cloud or Google cloud and some other cloud. Nobody's thinking about building that. So I think the common misconception for launching the solutions would be, oh, I need to go and fetch the license. In fact, what I think the founders should think about and the entrepreneurs should think about is, what is actually my core? Is it the finance or is it the tech? And often the answer is, it's actually the tech. And if that's the answer to your core question, if tech is what you're trying to market, in fact, then a path forward should be by building your core, building your tech, your envelope, your product offering, rather than building all of the infrastructure around it. And one should be great at something very specific, and this is what differentiates products. Nobody is differentiated by the fact that we have Amazon Cloud or Google Cloud. This is just infrastructure. So whenever thinking about building a FinTech product, one should probably start thinking about, what's the product offering? What are the elements that would attract customers? What are the features that would be interesting to my prospective customers? What is the business model? Rather than, oh, how do I get a license to operate as a bank in any particular geography in this world. So by asking the question, what is my core? What is my actual product about? I think really thinking about this and answering this question would help any entrepreneur or prospective founder to be more focused and more specific about what is actually important for the product. Now, with that being said, it's still impossible to build anything these days without the proper partnerships or the proper vendors, proper solutions to sort of be that under the water part of the iceberg. So the way I suggest some of the entrepreneurs should think about partnering is it's more an art with little snippets or elements of science to it. It's more about building the right partners or finding the right partners rather than trying to apply the very specific science. And the methodology that I would advise some of the people to use whenever choosing a partner would be a DAISY technology. So the DAISY approach would be about 5 key elements. So the first element is doing your intelligence. So probably the idea that you have in mind is novel, but not novel enough for anyone in the market not having to thought about it before. So probably there are companies in this world, products in this world, who've already started to build something very similar to what you're doing. But by doing your intelligence, by trying to study what exactly are they using in terms of tech, in terms of partners, is probably a good first starting point to understand what is it that you need to approach, what are the partners you need to approach to ensure that your product is going to be powered by the right partners, powered by the right infrastructure. The A in the DAISY stands for avoiding the vendor locks and minimum fees. Since most of the solutions in the fintech space and most of the partners in this space are the software as a service companies, a lot of those products, a lot of those solutions will try to create what's called a vendor lock. They will try to make sure that it's quite hard for you to sort of change the vendor whenever something goes south, or they're trying to impose the minimum fees onto you. In the very beginning, when you're just starting your product, you're just testing the market, you're just trying to find the product market fit, it's always better to go for a pay-as-you-go approach and try to avoid vendor lock by any means necessary. The third element would be around involving the tech experts. So sometimes the price of the services might look very attractive, and that price might try to sort of push you towards choosing this or that particular vendor. At the same time, there are many aspects from the technical standpoint, and I'm sure some of the panelists are going to cover that in the following sessions, would be around specific load requirements or specific functionality that the service either can or cannot offer. And those examples could be a make or break situation for your particular product. So trying to involve a tech expert to look at the API, to look at the functionality, to look at the ability to scale that solution would be essential in trying to find the right partner for your particular product. The S element, the fourth element in the DAISY approach would be to solve for TCO. So TCO stands for total cost of ownership. So whenever large companies are buying something, they often are looking at TCO, which is a total cost of ownership, not only the sign-on fees or ongoing fees, but also support fees, some of the mandatory elements of the product or mandatory payments that some of the products would impose on you. So be careful, look into fine print, look into the contract quite specifically. Don't be too excited about this one number which the company are going to provide you with. Be very diligent in the way you choose your product partner, and be very diligent about how you calculate the total cost of ownership. And the last element, but I think it's actually the most important, is you as an entrepreneur, you as a founder, you know best what's good for you. So whenever you feel that the partner you're working with somehow isn't a good match in terms of either customer service or contracting, or you feel you've hit the wall in the negotiations, maybe it's the sign that something isn't right for you, that maybe this isn't a right partner for you. And you should be really, really conscious of the fact that the good partnerships, they usually start good. And it's very, very rare when something is starting not ideal and then suddenly becomes ideal down the line. To summarize what the DAISY approach is about, it's about building fast, building your technology fast, use the proven solutions that are in the market, but contracting quite slow and be very diligent about the partners. To come back to the banks, I think the way to think about the banks is they're neither enemies nor friends to fintech startups. So the way to think about the banks is, I guess, quite straightforward. There are several things you can do with the banks and actually should do with the banks. And there's certain things you shouldn't be doing with the banks. So one of the elements which is essential to every business is opening a bank account. Even Coinbase, a crypto exchange has a bank account. You cannot avoid that. So start with a simple thing, open a bank account with them. If you're a lender, you can always look into using that bank's balance sheet to build your lending business. Often banks are looking to leverage their balance sheet and find alternative uses of their balance sheet through lenders. So if you're in lending business, one of the partnership allies you could be looking into can actually be trying to use the bank's balance sheets to help you with your lending business. Another element, which has been illustrated by one of the earlier slides, is trying to partner with the bank. Sometimes what you're offering is really complementing what the banks are offering. In this case, the bank would be interested to become a partner of yours and actually going to help you with all the regulatory and compliance infrastructure, which they're really good at. They're actually really good at maintaining their compliance infrastructure and regulatory infrastructure. And usually the bank you'll be partnering with is going to be 100 times or 1,000 times larger than you guys. And therefore, you can leverage their huge size to help you bring your business to the next level. Some of the tricks, tips that things that you shouldn't be doing with the banks, you shouldn't be under-communicating the way you're going to manage your account. It usually ends badly. So if you want to maintain a healthy relationship with the bank, be upfront. Tell them the way you're going to use your account. Don't try to undercut the bank. Usually they'll have a deeper pocket than you guys, and this is going to end badly for you. You shouldn't be looking down on their tech either. So those banks, the traditional banks, have been in the market for dozens of years, if not hundreds. They're like grandpas. Show some respect to a grandpa. They've built their business. They've grown for all of those years. You should be respectful of the way they've built their business and they spitting out those returns year on year. Don't try to bend the rules. Don't try to be smart with the bank. Usually the largest asset of a small bank is actually their license. So trying to bend the rules on either customer onboarding or transaction monitoring isn't a good idea. Overall, just try not to eat their cake. Try to eat the cake which you can share. And this is a good approach with any bank. So I guess this concludes my presentation. Whoever is feeling like a consultation could be in place, or you might be looking for an advice on building a fintech business, feel free to connect via LinkedIn. The QR code is going to lead to my profile. We can connect, and I'll offer a free consultation on the matter for sure. At that, I'm going to conclude my monologue, and I guess going to hand it over back to Johan for any questions that